Welcome back to the channel. Today we're diving into the rate of change, ROC indicator, a powerful tool for traders. Now I know what some of you might be thinking, another indicator? But trust me, this one is a gem, and understanding how to use it effectively can genuinely make a difference in your trading game. We're going to break down exactly what the ROC is, how it's calculated, no complicated math I promise, just the essentials you need to know, and most importantly, how you can interpret its signals to potentially make some smart moves in the market. We're talking about identifying momentum, spotting potential reversals, and really getting a feel for the underlying strength or weakness of a price trend. My goal here is to give you actionable insights. It's not just about theory, it's about how you can take this indicator, apply it to your charts, and start seeing the market in a new light. Whether you're a seasoned trader looking to refine your toolkit, or a beginner just starting to explore technical analysis, I believe there's something incredibly valuable here for you. We'll go through practical examples, discuss different trading strategies using the ROC, and even compare it to other popular indicators so you know exactly when and how to deploy it for maximum impact. Think of this as your comprehensive guide to mastering the ROC. So grab a coffee, get comfortable, and let's get into it. By the end of this video, you'll have a much clearer understanding of the rate of change indicator and how it can help you spot those trading opportunities that others might miss. We're going to cover everything from the basic formula to advanced trading techniques, so make sure you stick around. It's all about giving you the knowledge to make more informed decisions, and hopefully, more profitable ones. Let's make some money. Alright, so first things first, let's get into how this rate of change, or ROC indicator, is actually calculated. Now don't worry, you don't need to be a math whiz to understand this. It's actually pretty straightforward, and knowing the mechanics behind it will really help you appreciate what it's showing you on the charts. The core idea is to measure the percentage change in price between the current price and the price a certain number of periods ago. It's all about speed and momentum, how quickly the price is moving up or down. The formula itself is simple. ROC equals, and get ready for this, open parenthesis, the current price minus the price in periods ago, close parenthesis, then you divide that whole thing by the price in periods ago, and finally, you multiply the result by 100 to get a percentage. So it's essentially, current price, price n periods ago, price n periods ago, asterisk 100, see? Not too scary. This percentage tells you how much the price has changed, relative to where it was in periods back. Now, let's break down those components a little bit. Current price is pretty self-explanatory. That's the most recent closing price of the asset you're looking at, whether it's a stock, a crypto, or Forex. It's the price right now, or at the close of the latest bar on your chart. This is your anchor point, the most up-to-date piece of information you're working with for the calculation, and it's crucial for understanding the immediate momentum. Then we have price n periods ago. This is where the n comes in. N simply represents a number of past periods you choose to look back. This could be days, weeks, or even minutes if you're a scalper, depending on your trading time frame. The n is a variable you can often customize in your charting software. So if n is 14, you're comparing the current price to the price 14 periods ago. This historical price point provides the baseline for measuring the change. The default setting for n in many charting platforms is often 14 periods. So, if you're looking at a daily chart, the ROC will typically compare the current day's price to the price 14 days ago. If you're on a weekly chart, it's 14 weeks ago. This 14-period lookback is a common starting point, but you can adjust it. A shorter n will make the ROC more sensitive to recent price changes, while a longer n will make it smoother and reflect longer-term momentum. Understanding this n value is key because it directly impacts how the ROC behaves. If you choose a very small n, say 5 periods, the ROC line will be very choppy and will react very quickly to small price fluctuations. This might be good for very short-term trading, but it can also generate a lot of false signals. On the other hand, if you choose a larger n, like 50 periods, the ROC line will be much smoother, showing you the broader, more sustained momentum shifts. So, when the ROC calculates this percentage, if the current price is higher than the price n periods ago, the ROC value will be positive. This indicates upward momentum, or buying pressure. Conversely, if the current price is lower than the price n periods ago, the ROC value will be negative, indicating downward momentum, or selling pressure. And if the price is exactly the same, the ROC will be zero, suggesting a lack of momentum or a sideways market for that specific period. The beauty of this calculation is its simplicity and directness. It's not getting muddled with lots of different variables. It's a pure measure of price velocity. It tells you, in no uncertain terms, how fast and in what direction the price has moved over your chosen look-back period. This makes it a really clean way to gauge the strength behind a price move, which is critical information for any trader, and that's essentially it for the calculation. No complex algorithms, just a straightforward comparison of prices over time, expressed as a percentage. This percentage is then plotted as a line on your chart, usually below the main price chart, oscillating above and below a zero line. In the next chapter, we'll dive into how to interpret what this oscillating line is actually telling you about the market. But for now, just remember that formula and what each part represents. Okay, so now that we know how the rate of change indicator is calculated, let's get into the really important part: how to interpret what it's showing you. This is where the magic happens, where you turn those numbers and lines into actionable trading insights. The ROC is primarily a momentum indicator, so it's all about gauging the speed and strength of price movements. When you see that ROC line moving on your chart, it's giving you clues about the underlying bullish or bearish pressure. The most fundamental interpretation revolves around the zero line. When the ROC indicator is above the zero line, it generally signifies that there's bullish momentum in the market. This means that, over the look-back period and we talked about, prices have been increasing. The further the ROC climbs above zero, the stronger that upward momentum is considered to be. So, a rising ROC above zero is a pretty positive sign for the bulls. Conversely, when the ROC indicator dips below the zero line, it typically indicates bearish momentum. This tells you that prices have been falling over the specified end periods. The further the ROC drops below zero, the stronger the downward momentum, or selling pressure, is perceived to be. So, a falling ROC below zero is a signal that the bears are in control, and you should be cautious if you're thinking of buying. But it's not just about being above or below zero. The ROC can also help you identify potential overbought and oversold conditions, much like other oscillators. While the ROC doesn't have a fixed upper or lower boundary like the RSI, which goes from 0 to 100, traders often look for extreme readings to signal that a price move might be overextended and due for a correction or reversal. These extreme levels aren't set in stone. They can vary depending on the asset being traded and its historical volatility. Typically, for many assets, traders might consider ROC values above 10% or 20% as potentially overbought. When the ROC reaches these high positive levels, it suggests that the price has risen very rapidly, and the buying momentum might be getting exhausted. This doesn't automatically mean you should sell, but it's a warning sign that the rally could be losing steam, and a pullback might be on the horizon. It's a heads up to be vigilant. Similarly, ROC values below -10% or -20% are often considered potentially oversold. When the ROC falls to these extreme negative levels, it indicates that the price has dropped very sharply, and the selling pressure might be waning. Again, this isn't an automatic buy signal, but it suggests that the downtrend could be overextended, and a bounce or reversal might be approaching. It's a signal to start looking for signs of a bottom. Another crucial aspect of interpreting the ROC is looking for reversals, and these can often be signaled when the ROC crosses that central zero line. A crossover from below zero to above zero can be a bullish signal, suggesting that momentum is shifting from bearish to bullish. This could be an early indication of a new uptrend forming or a resumption of a previous uptrend after a correction. Many traders look for this as a potential entry point for long positions. On the flip side, a crossover from above zero to below zero can be a bearish signal. This suggests that momentum is shifting from bullish to bearish, potentially signaling the start of a new downtrend or a resumption of a prior downtrend after a rally. This could be seen as a signal to exit long positions or even consider short selling opportunities. These zero-line crossovers are one of the most common ways traders use the ROC. Furthermore, pay attention to how the ROC behaves at these extreme overbought or oversold levels. If the ROC hits an extreme positive level and then starts to turn down, even if it's still above zero, it can be an early warning of weakening bullish momentum. Likewise, if it hits an extreme negative level and then starts to turn up, even while still below zero, it can signal weakening bearish momentum. These subtle shifts can provide valuable early clues. Alright, we've covered the calculation and basic interpretation of the ROC. Now for the exciting part, how do we actually use this indicator to make trading decisions? What are some concrete strategies you can implement? Because at the end of the day, that's what we're all here for, right? To find ways to improve our trading and hopefully our profitability. There are several popular strategies involving the ROC, and I'm going to walk you through 3 key ones. First up, we have the zero-line crossover strategy. This is perhaps the most straightforward way to trade with the ROC. As we touched upon earlier, the zero line is a critical level. The strategy is simple. When the ROC crosses above the zero line from below, it's generally considered a buy signal. This indicates that momentum has shifted from negative, bearish, to positive, bullish, suggesting that an upward price move might be starting or resuming. Conversely, when the ROC crosses below the zero line from above, it's typically taken as a sell signal. This suggests that momentum has shifted from positive, bullish, to negative, bearish, and a downward price move could be imminent. This strategy is all about catching the early shift in momentum. Of course, like any indicator, it's not foolproof, and you might get some false signals, especially in choppy sideways markets. That's why confirmation from other indicators or price action analysis is always a good idea. The second strategy is the overbought and oversold strategy. This one focuses on those extreme rocky readings we talked about. Remember, these levels, like 10%, 20% for overbought, and negative 10%, negative 20% for oversold, are subjective and can vary. The idea here isn't just to sell when it's overbought or buy when it's oversold, because strong trends can remain overbought or oversold for extended periods. Instead, you wait for a confirmation of a potential reversal. So, for a buy signal using this strategy, you'd look for the ROC to dip into an extreme oversold territory, for example below negative 10% or negative 20%. Then you don't just buy immediately. You wait for the ROC to start recovering and cross back that oversold threshold, or even better, show some upward momentum. For a sell signal, you'd look for the ROC to push into an extreme overbought zone, for example above 10% or 20%. Then, you'd wait for the ROC to start declining from that extreme positive level, signaling that the buying frenzy might be over. The third powerful strategy is the ROC divergence strategy. Divergence occurs when the price of an asset is moving in one direction, but the ROC indicator is moving in the opposite direction. This discrepancy can be a very strong signal that the current price trend is losing momentum and might be about to reverse. There are 2 types of divergence, bullish and bearish. This is a more advanced technique but can be incredibly insightful. Bullish divergence happens when the price is making lower lows, continuing a downtrend, but the ROC indicator is making higher lows. This suggests that even though the price is still falling, the selling momentum is weakening. This can be a powerful buy signal, indicating a potential bottom and an upcoming upward reversal. You're essentially seeing the selling pressure dry up before the price itself reflects it. Bearish divergence, on the other hand, occurs when the price is making higher highs, continuing an uptrend, but the ROC indicator is making lower highs. This indicates that even though the price is still climbing, the buying momentum is fading. This can be a strong sell signal, suggesting a potential top and an impending downward reversal. The upward trend is running out of steam, even if the price hasn't peaked yet. When trading divergences, it's crucial to wait for some confirmation. Just because you see divergence doesn't mean the price will reverse immediately. You might look for a break of a trend line on the price chart, or for the ROC to cross the zero line in the direction of the divergence, to confirm the signal before entering a trade. These strategies, when used thoughtfully and often in conjunction with other forms of analysis, can significantly enhance your trading toolkit with the ROC. Now that we've gone over some trading strategies, let's make this even more practical by looking at some specific scenarios and how you'd interpret the ROC signals. Seeing these examples play out can really help solidify your understanding. Imagine you're looking at your charts, the ROC indicator is plotted below, and you start seeing certain patterns emerge. What do they mean, and what's the potential action? Let's take the first scenario: overbought conditions. Suppose you're tracking a stock that's been on a tear, rallying hard for several days or weeks. You look at your ROC indicator, and you see it has surged well above your predetermined overbought level, say 15% or 20%. This is a clear indication that the upward momentum has been exceptionally strong, perhaps too strong, too fast. The signal here is one of caution for bulls and a potential alert for bears. In this overbought scenario, the primary interpretation is that the asset might be due for a pullback or a consolidation phase. The buying pressure could be getting exhausted. So if you're holding a long position, this might be a signal to consider taking some profits off the table or tightening your stop loss. If you're looking to enter a new long position, this is probably not the ideal time. You might want to wait for a dip. For aggressive traders, seeing the ROC turn down from this overbought level could even be an early signal to look for short selling opportunities, especially if confirmed by other bearish signals. Now let's flip that for our second scenario, oversold conditions. Imagine a stock has been hammered, prices have been dropping sharply, and fear is palpable in the market. You check the ROC, and it's plunged deep into negative territory, perhaps below -15% or -20%. This tells you that the selling momentum has been intense. The asset has fallen significantly and rapidly. This is a classic oversold reading according to the ROC. In this oversold situation, the interpretation is that the selling pressure might be nearing exhaustion, and the asset could be due for a bounce or even a reversal to the upside. If you're already short, this might be a signal to consider covering your position and banking those profits. If you're looking for a buying opportunity, seeing the ROC start to turn up from these extreme negative levels could be an early indication that a bottom is forming. Again, you'd look for confirmation, but the ROC is flagging a potential exhaustion of the downtrend. Our third scenario involves bullish divergence, which we touched on earlier. Let's say a stock's price has been making a series of new lows. For example, it hits $50, then pulls back, then drops to 48, then pulls back, then drops to 46. Each low is lower than the previous one. However, when you look at the ROC indicator during this same period, you notice that the lows on the ROC are getting higher. So while the price made a lower low at 46 compared to 48, the ROC's low corresponding to the 46 price point is actually higher than its low when the price was 48. This is classic bullish divergence. The price is falling, but the momentum of the fall is decreasing. It's like a ball bouncing, and each bounce is weaker than the last, even if it's still going down. The signal here is a potential buy. It suggests that the sellers are losing conviction, and the downtrend might be ready to reverse. Traders would look for this as an early warning of an upcoming rally, often waiting for a price confirmation like a break above a recent swing high, or the ROC crossing above zero. Finally, our fourth scenario is bearish divergence. This is the opposite of bullish divergence. Imagine a stock is in a strong uptrend, making higher highs, say $100, then $105, then $110. Each peak is higher than the last, but when you look at the ROC indicator, you see that the highs on the ROC are getting lower. So when the price hit 110, the ROC's peak was lower than its peak when the price was at 105. This is bearish divergence. The price is rising, but the momentum behind the rise is weakening. It suggests that the buyers are losing steam, and the uptrend might be running out of gas. The signal here is a potential sell or a warning to exit long positions. It's an early indication that the rally might be topping out, and a correction or reversal downwards could be on the cards. Again, confirmation would be sought, perhaps a break of a key support level or the ROC crossing below zero. These scenarios show how ROC can provide nuanced insights beyond simple crossovers. Alright, so we've seen how the rate of change indicator works, how to interpret it, and some strategies for trading with it. It sounds pretty great, right? And it often is. But like any tool in a trader's arsenal, the ROC has its own set of pros and cons. It's really important to understand these so you can use it effectively and know its limitations. No indicator is a magic crystal ball, and the ROC is no exception. Let's start with the pros, the good stuff. One of the biggest advantages of the ROC is its simplicity. The calculation is straightforward, as we saw, and its interpretation, especially around the zero line and divergences, is relatively easy to grasp compared to some more complex indicators. This makes it accessible even for traders who are newer to technical analysis. You don't need a PhD in quantitative finance to understand what it's telling you. Another major pro is its effectiveness in gauging momentum. That's its core job, and it does it well. It clearly shows you the speed and direction of price changes, which can be invaluable for momentum-based trading strategies. If you're trying to catch trends or ride strong price moves, the ROC can be a fantastic companion, helping you confirm the strength of that momentum or warning you when it's starting to fade. The ROC is also quite useful for trend confirmation and reversal detection. When a trend is strong, the ROC will typically stay consistently above or below the zero line. If it starts to flatten out or cross the zero line against the prevailing trend, that can be an early warning. And as we discussed with divergences, it can provide some of the earliest signals that a trend might be about to reverse, often before price action alone makes it obvious. This early warning capability is a significant plus. Furthermore, the ROC can be adapted to different timeframes and assets by adjusting the end period. A shorter end for short-term fast-moving markets, and a longer end for longer-term trend analysis. This flexibility means it's not a one-size-fits-all indicator that only works in specific conditions. You can tailor it to your preferred trading style and the characteristics of the instrument you're trading. This adaptability is a key strength for versatile traders. However, now we need to talk about the cons, the potential downsides. One of the main drawbacks of the ROC is its potential to generate false signals, especially in sideways or ranging markets. When there's no clear trend and prices are just chopping back and forth, the ROC can whip above and below the zero line frequently, giving you a series of buy and sell signals that don't lead anywhere profitable. This is a common issue with most momentum oscillators. Because the ROC is unbounded, it doesn't have fixed limits like 0 and 100 on the RSI. Determining truly extreme overbought or oversold levels can be subjective and can vary significantly between different assets and even different market conditions for the same asset. What's overbought for a stable blue-chip stock might be normal volatility for a highly speculative crypto. This requires some historical analysis and judgment from the trader. Another important consideration is that the ROC, like many indicators, is based on past price data. This means it's a lagging indicator to some extent. While it measures current momentum relative to the past, it's not predictive in the sense of telling you the future with certainty. It's showing you what has happened and what is happening to momentum, from which you infer potential future movements. This lag can sometimes mean you get into a trend a bit late or out of it a bit late. And this leads to a crucial point. The ROC often works best when used in conjunction with other indicators or forms of analysis. Relying solely on ROC signals can be risky due to the potential for false signals. Traders often combine it with trend-following indicators like moving averages or other oscillators like the RSI or MACD, or even candlestick patterns and support-resistance levels to confirm signals and filter out the noise. This confirmatory approach is highly recommended. So, while the ROC is a powerful tool for measuring momentum and identifying potential trading opportunities, it's vital to be aware of its weaknesses. Understanding that it struggles in non-trending markets and that its signals are best confirmed can help you use it much more effectively and avoid some common pitfalls. It's about using it intelligently as part of a broader trading plan. Alright, one common question I get when discussing momentum indicators is how the rate of change, or ROC, compares to another very popular momentum oscillator, the Relative Strength Index, or RSI. Both are designed to measure momentum, but they do it in slightly different ways and have different strengths. Understanding these differences can help you decide which one might be more appropriate for your specific trading strategy, or if you should perhaps even use both. Let's first recap what the ROC does. As we've established, the ROC measures the percentage price change over a specific N period. It directly tells you the price has changed by X% over the last N bars. Its output is a percentage, and it oscillates above and below a zero line with no fixed upper or lower boundary. Its primary strength is in identifying the acceleration or deceleration of price movements, how fast things are speeding up or slowing down. Now let's consider the RSI. The Relative Strength Index, developed by J. Wells Wilder, also measures the speed and change of price movements. But its calculation is a bit different. It compares the magnitude of recent gains to recent losses over a specified time period, typically 14 periods, just like the common ROC default, and then plots this as an oscillator that ranges between 0 and 100. It's a bounded oscillator. The key difference in calculation leads to different interpretations and uses. The ROC, by showing a direct percentage change, is excellent for seeing raw momentum power. If the ROC is at 5%, you know the price is up 5% from N periods ago. If it jumps to 10%, that momentum has doubled. This directness is very intuitive for understanding the velocity of price changes. It's great for strategies that rely on identifying strong, accelerating trends. The RSI, on the other hand, with its 0 to 100 bounded scale, is particularly well known for identifying overbought and oversold conditions. Traditionally, RSI readings above 70 are considered overbought, and readings below 30 are considered oversold. Because it's normalized to this 0 to 100 range, these levels are more standardized across different assets, although some traders still adjust them based on volatility. The ROC can show extremes, but defining extreme is more asset-specific. So when would you choose one over the other? If your primary goal is to identify the raw speed or acceleration of price, and you're less concerned with fixed overbought-oversold levels, the ROC might be your preferred tool. It gives you a clear, unadulterated look at the rate of price change. It's also very good for spotting divergences, as the percentage change can highlight subtle shifts in momentum quite effectively. If, however, your strategy heavily relies on identifying fairly standardized overbought or oversold levels, to look for potential reversals or points of exhaustion, the RSI is often the go-to indicator. Its bounded nature makes these 70-30 levels or similar, like 80-20, consistent reference points. The RSI is also very popular for divergence trading, just like the ROC, so there's overlap there. Another difference is how they react. The ROC, being a direct percentage change, can sometimes appear choppier or more volatile than the RSI, especially with shorter look-back periods. The RSI incorporates a smoothing mechanism in its calculation. It uses an exponential moving average of gains and losses, which can sometimes make its line appear smoother and less prone to very short-term whipsaws compared to a raw ROC. Ultimately, it's not always about ROC versus RSI. Sometimes it's about ROC and RSI. Some traders use both. They might use the ROC to gauge the raw power and acceleration of a move and look for divergences, while simultaneously using the RSI to get a more standardized read on overbought, oversold conditions. Using them together can provide a more comprehensive picture of market momentum, with each indicator confirming or complementing the signals of the other. So, to sum it up, ROC is fantastic for its direct measure of percentage price change and identifying acceleration, with no fixed range. RSI excels at providing standardized overbought, oversold levels due to its 0 to 100 bounded range and smoothed calculation. Think about what aspect of momentum is most critical for your trading decisions, and that will guide you to which indicator or combination of indicators will serve you best. Experiment with both on your charts and see which one resonates more with your style. Alright, that wraps up our deep dive into the rate of change or ROC indicator. We've covered how it's calculated, how to interpret its signals, various trading strategies like zero-line crossovers and divergences, real-world examples, its pros and cons, and even how it stacks up against the RSI. My hope is that you now have a solid understanding of this powerful momentum tool and feel more confident about incorporating it into your own trading analysis. Remember, the key is practice. Apply it to your charts, observe how it behaves with different assets and time frames, and see how it can complement your existing strategies. The ROC isn't a standalone solution, but it's an incredibly valuable piece of the puzzle when it comes to understanding market dynamics. By paying attention to momentum, you can often get early clues about trend strength and potential reversals. Use it wisely, combine it with other forms of analysis for confirmation, and always manage your risk. The goal is to make more informed, data-driven decisions, and the ROC can certainly help you do that. Keep learning, keep testing, and keep refining your approach. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more trading tips and strategies. Your support means the world and helps the channel grow, allowing me to bring you more content like this. Drop a comment below if you have any questions or if there are other indicators you'd like me to cover. See you in the next video.